Welcome back to the deep dive. This is where we take all that dense source material, the market filings, the reports you send us, and really give you that shortcut to being truly informed. We do the digging so you don't have to.
And today, our focus is squarely on a giant, Bank of America Corporation, or BAC. We're digging into their Q3 2025 earnings analysis.
Right, and our mission here isn't just, reading out the numbers. We're using our structured five-part framework to get way beyond the headlines. Did they beat? Okay, fine. But how? What drove those profits? That's what we want you to understand.
Exactly. That framework is crucial, especially for a complex institution like BofA. The top-line number, even the net income, it doesn't always tell the full story. We need to pinpoint what's driving profit, check the financial health underneath. Is it sustainable strength or just a good quarter?
Okay, let's get into it then. Let's unpack the data. Now for slide 1, the at-a-glance scorecard.
All right, so starting with the big picture,
Oh.
the verdict's pretty clear. This was a strong beat. BAC outperformed what Wall Street was expecting on both revenue and on earnings.
Okay, how strong? Give us the numbers, top and bottom line.
So total revenue landed at $28.1 billion. That's up a healthy 11.1% compared to last year. And it beat the consensus estimate, which was around $27.58 billion. So good start there.
11.1% revenue growth, solid. But like you said, the earnings story is where it gets really interesting for anyone watching the stock. Net income jumped 26% year over year to $8.04 billion. And the key number, diluted earnings per share, EPS, that hit $1.06.
Which was way above the $1.95 analysts were looking for, a 30.9% jump in diluted EPS year over year.
Wow. Okay, so 30.9% EPS growth versus 11.1% revenue growth. That's a huge difference.
That's the EPS amplifier we flagged. It's massive. Earnings growing almost 3 times faster than revenue doesn't just happen by accident. That tells you something fundamental is going on with profitability.
So how do they manage that? What's behind that amplifier effect? The analysis points to kind of a 1-2 punch.
Yeah, the first part is good old-fashioned operational leverage. Like we said, revenue grew 11.1%. But crucially, they kept a lid on costs. Non-interest expenses only grew 5%, much slower.
So more of that new revenue is dropping to the bottom line.
Precisely. The CEO, Brian Moynihan, actually called this out. He said, and I'm quoting roughly here, as revenues grew much faster than expenses, we drove good operating leverage. Pretty direct.
Okay, so that's factor 1. What's the second part of that punch?
Factor 2 is more mechanical, but very strategic. Share repurchases, buybacks. The company spent a significant $5.3 billion buying its own stock back during the quarter.
$5.3 billion, and that reduces the number of shares out there, right?
Exactly. It cut the average diluted common shares outstanding by about 3.5%. So when you take that $8.04 billion in net income and divide it by fewer shares, boom, your earnings per share gets a guaranteed lift. It's math, but also signals management confidence.
And just a quick reminder for everyone listening, diluted EPS, that's the number we're focused on here. It's generally seen as the more conservative measure because it accounts for all potential shares, like from options or convertible debt. It's the one investors really watch.
Definitely.
Moving to slide 2, the engine of profitability. Okay, so that huge EPS jump is impressive, but the next logical question is, how efficient are they really being? Is this sustainable? We need to look beyond the absolute dollars now.
Right. We need the efficiency ratios. These tell us how effectively management is actually using the capital they have, particularly shareholder capital.
So where do we start? How about return on tangible common equity, ROTCE?
Good place. BAC reported ROTCE of 15.4%. That's a strong number. Think of it as stripping out things like goodwill, the fuzzier stuff on the balance sheet, to see the core return on the actual tangible equity shareholders have invested. High ROTCE, like 15.4%, suggests they're putting that money to work very effectively.
And we saw evidence of that efficiency drive earlier with the operating leverage. Does that show up in the efficiency ratio too?
It does, very clearly. The efficiency ratio measures their non-interest expenses as a percentage of their revenue. Lower is better. And BAC's improved significantly by 329 basis points, down to 62% for the quarter.
So that drop, that's the numerical proof of the operating leverage we just talked about in slide 1. It all connects.
Exactly. And the CFO, Alistair Borthwick, he actually gave reasons for it. He pointed to their investments in technology, in talent, and the overall client experience helping drive that better efficiency. So strategic spending leading to better ratios.
Interesting. Now, if we want to get an even cleaner look at just the core recurring operational profit, there's another metric, right? Pre-tax, pre-provision income, PTPP.
Yes, PTPP is great for that. It takes earnings before taxes and before setting aside money for potential loan losses. Those provisions can be really volatile depending on the economic outlook. So PTPP gives you a clearer view of the underlying engine.
And how did that look?
Looked very strong. PTPP for Q3 came in at $10.8 billion. That's up a really robust 21.3% from the same quarter last year. So it underlines that the fundamental business, stripping out taxes and credit worries, is performing very well.
Okay, strong core performance. Let's see where it came from. Moving to slide 3, the engine room business segment performance. Now we get into the different parts of the bank. And the big story here seems to be diversification and just broad strength, really. The report says all 4 main business segments grew both revenue and net income compared to last year.
That diversification is absolutely key to their model. It wasn't just one area carrying the weight. Let's tick through them. First up, consumer banking. This is their biggest piece, right? Nearly 40% of the net income.
And how did it do?
Revenue grew 7% year over year. The main driver there was higher net interest income, or NII. Basically, they earned more on their loans than they paid out on deposits, helped quite a bit by the favorable interest rate environment.
Makes sense. Okay, what about the wealth management side? GWIM.
Global Wealth and Investment Management, yeah. Revenue climbed 10% year over year. And what really fueled that was a big jump, 12%, in asset management fees.
So that's partly markets being up, boosting portfolio values.
Partly that, yes. Higher market valuations helped, but they also highlighted strong net client asset flows, meaning people are actually bringing more money to BOFI to manage, which is a great sign.
Got it. Okay, next up, global banking. This often reflects what's happening in the broader corporate world, right?
It does. And revenue here grew 7%, but the real eye-popper within global banking was investment banking fees. Total IB fees for the whole company surged 43% year over year to hit $2.0 billion.
Oh, hang on, 43%? That's huge. Is that sustainable or just a backlog of deals finally closing?
That's the million-dollar question, isn't it? Management sounded confident, but yeah, 43% jump often means some catch-up from prior periods. It was definitely a massive boost this quarter, regardless.
Fair enough. Okay, and the last main segment, global markets.
Their trading division. Also strong results. Revenue up 11%. Within that, sales and trading specifically rose 9%, and they called out particular strength in equities trading, which jumped 14%. So clients were active, markets were maybe a bit volatile, and BOFA navigated it well.
Okay, so strength across the board, really. Let's talk about the foundation. Moving to slide 4. Financial strength and shareholder rewards. So clearly a very profitable quarter. But for a bank, profit today doesn't mean much if the foundation isn't rock solid, right? This next part looks at their ability to absorb losses and, crucially, reward shareholders.
Exactly. And the key metric regulators and investors watch here is the capital buffer, specifically the Standardized Common Equity Tier 1 ratio, or CET1. Think of it as the bank's highest quality capital cushion against unexpected trouble.
And where did BOFA stand on CET1?
They reported 11.6% at the end of the quarter. The report notes this is well above the regulatory minimum.
Okay, so they have plenty of cushion. And that cushion isn't just for safety, is it? It directly enables what shareholders often care most about, returns.
Precisely. This is where it gets really important for you, the listener, to connect the dots. Because they have that strong 11.6% CET1 ratio, way above the minimum. They have the capacity and the regulatory green light to return significant capital to shareholders.
And they certainly did that this quarter. How much in total?
A huge $7.4 billion returned to shareholders just in Q3.
Wow. And how did that break down?
It was $2.1 billion paid out in common stock dividends. And then the big one we mentioned earlier, $5.3 billion used for those share repurchases.
Right. And this ties everything together, doesn't it? This virtuous cycle idea.
Exactly. It works like this. 1, build up strong capital, get that high CET1 ratio. 2, that strength gives regulators confidence to approve big capital return plans. 3, the bank executes those plans, especially large buybacks like the $5.3 billion one. 4, those buybacks reduce the share count, which mechanically boosts EPS. It connects the solid foundation directly back to that amplified earnings beat we saw in slide 1. Strong capital enables big buybacks, which turbocharge EPS. It's a powerful loop when it works.
Okay, really clear picture there. Let's bring it all together with the outlook. Moving to slide 5, a road ahead management's outlook and key takeaways. So, wrapping things up, what was the overall tone from management looking forward? And what are the main things you should take away from this quarter?
The tone from leadership was definitely confident. They really emphasized that their long-term strategy, particularly the diversified model, is working as intended.
Any specific comments that stood out?
Yeah, CEO Moynihan, he talked about how their effective balance sheet positioning led to, quote, record net interest income. And he summed up the quarter nicely. Every line of business reported top and bottom line improvements, just reinforcing that broad strength.
And the CFO?
CFO Borthwick echoed that, highlighting the, quote, earnings power of our diversified model. He also made a point of noting improved asset quality, including a decline in net charge-offs, that's loans actually going bad, which is definitely a positive sign.
Okay, so if we synthesize all of this, boil it down to the essentials for you, the listener, what are the main conclusions?
I think we can break it down into 4 key takeaways.
Okay, number 1.
First, a decisive beat. They clearly beat expectations, and it was fueled by that broad-based strength. All 4 major segments contributed, all were up year over year.
Second takeaway.
Second, profitability was powerfully driven by operating leverage. Remember that? Near 3x difference, 30.9% EPS growth versus 11.1% revenue growth.
Yeah.
That margin expansion was key.
Third point.
Third, shareholder value was significantly amplified through capital returns. That massive $7.4 billion total return, made possible by the strong 11.6% CET1 capital ratio and those big buybacks.
And finally.
And fourth, they benefited from multiple tailwinds hitting at the same time. You had favorable rates helping the consumer bank, strong markets boosting wealth management, and that big rebound in capital markets activity. Everything kind of clicked into place this quarter.
So the overall narrative seems to be, this wasn't just luck. It was a well-executed strategy, hitting its stride and capitalizing effectively on favorable conditions. That created the virtuous cycle we talked about, operational success, driving amplified per-share returns. And hopefully, walking through this using our 5-part framework from the scorecard to profitability engines to the segments, the balance sheet, and the outlook shows you how you can build a much deeper understanding than just reading headlines. It's a repeatable process for your own analysis.
Absolutely. Now, before we finish, we do have our standard disclaimers.
That's right. Please remember this deep dive is strictly for informational purposes. It is not financial, investment, legal, or tax advice. Any investment decisions you make should always be based on your own thorough research and ideally in consultation with a qualified financial professional.
And a note on our process. The underlying report that informed this analysis was generated using an artificial intelligence model. It integrated data from official company press releases and public market data sources. However, you should always independently verify any information before relying on it.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.